Welcome to the Real Estate Investors Weekender Podcast. This podcast is brought to you by the award-winning editorial staff at NREIOnline.com. Let's jump right into this week's top news, features, and blog posts.
Welcome to NREI Weekender with your host, David Bodamer. Let's dive into this week's top stories. Good afternoon, David. How are you?
I'm doing all right. How are you?
I'm doing fine. Fantastic. Ready for the news. What are we covering today?
Well, we got some interesting new pieces from the week. We're going to look at some of the stuff that we covered this week. We looked at how high net worth investors, what some of their investment patterns in based on a new study that came out and how that aligns with some things we've seen previously. There was also some interesting data on a power center investment. We had a piece that looked on bank exposure risk on commercial real estate lending and how that's creeping up. Also, a piece about apartment building owners grappling with some of the tougher standards that are being placed on them in terms of energy use and other green initiatives. And then lastly, wanted to touch on what's going on with self-storage development. So that's what we got for this week.
All right. You said an AppFolio survey has found out some information about high net worth investors. What do we got here?
Yeah, so this is an interesting piece. I mean, high net worth investors have been of particular interest to the commercial real estate sector in the past, I don't know, probably 5 to 10 years, partly because this universe of investors keeps getting larger. And as their name would suggest, they have a lot of capital. Now, a lot of their advisors, in terms of trying to achieve their investment returns, will tell them put a certain amount of money in equities, put a certain amount in bonds, and then commercial real estate is often also recommended as part of their bucket. So this is where both the opportunity and challenges come in, and I think this is what some of these new survey findings were underscoring. One thing is that it found that a big challenge for high net worth investors, especially when they're trying to invest in property, is finding investment managers that have the expertise to kind of guide those kind of investments. And then another piece of it was when they are investing in commercial real estate, where their preferences lie. So those were kind of the couple of the takeaways that I had from it. Starting with the second thing first, what the study found in terms of the property types is that high net worth investors prefer multifamily, and then office ranked second. So this was pretty interesting. And industrial ranked third. So the issue or the thing that's interesting, multifamily being the top is not that surprising because that's the best performing commercial real estate sector for many years. It's a stable investment. It's got a good outlook. There's not much indication that there are concerns for it. But office finishing above industrial is an interesting outtake here, partly because on a performance basis, industrial has performed better and has probably a better outlook than the office sector does. So the fact that high net worth investors have a reverse preference for that is sort of interesting.
Yeah, I would think there'd be a little bit more security.
Yeah. I mean, in terms of if you're investing in industrial there, I think that's a more secure investment at this point.
Exactly.
I think what we found is that partly when you're looking at high net worth investors, they have another factor that comes into play besides just the performance of getting the returns or the security in the investment. And there's a little bit of a vanity play.
Really?
So if you think about it, they're going to buy some real estate. They want to be able to point to a nice building. And then if you think about, okay, a nice apartment building could be a fairly nice thing, especially in urban settings. So, a nice big apartment building can be a nice thing,
as opposed to a big old warehouse.
Yes, exactly. That's exactly where it's going. Yeah. So it's like warehouses don't seem that like sexy.
Not that I've seen. I haven't seen a whole lot that are dressed up in high heels or anything that would really turn my fancy as far as a warehouse is concerned.
Right. As opposed to like a nice fancy office building or even a nice suburban office campus or an apartment building. I think those might seem more tangible to that kind of investor as opposed to an industrial building, which looks like a plain vanilla box. Could.
Gotcha.
So I think that relates to actually the other point that the survey had is that concern of these investors is who are they working with, who's managing their funds, and if the person that they're working with, I think, can point them to the sector that might get them the better returns, that might be a good thing. But it seems like part of that as well is there was a time where getting quarterly reports or annual reports on your investments was enough. But now, with just given the society we live in, it sounds like people want more frequent reporting of their data as well. So they want both an investment manager that's got the experience, but also can give them a lot of data on a real-time basis. So there's like a technology aspect to it as well as a competency aspect to it.
Yeah, I mean, it's a microwave generation, right? It's instant gratification. I want to know exactly what's going on when I want to know what's going on, because I think they feel like they have more power in that situation, don't you?
Yes, I think that's true. And then I think it's also like if you're comparing it to like, okay, I own a stock, I can see how that's if that's up or down every single day. Real estate doesn't really function like that, so it's not going to vary on that kind of same basis. But I think I guess trying to bridge the gap of giving them more reporting on how their asset is performing or their investments are performing is what they want.
Yeah. Does the ability to buy or sell, or how liquid an investment is in these three categories, are any of them better than the other, to where somebody would say, if I want to sell, I can sell this type of property more quickly, so I'd rather be a little bit more flexible than something that I feel like I'm locked into, or is that make a difference at all?
I think it's a good question. I think for a high net worth investor in real estate, they may not be as concerned about liquidity and flipping assets as opposed to wanting, if you think about where real estate may fit in their portfolio, it's probably a longer term play.
It should be,
where they're looking for a return. But I think, if they were looking, but some of them may have bigger exposure, may want to do that. So I think the ones that are performing the best and in most wide demand, which are the ones we talked about, multifamily or industrial, there's just a lot of demand for them. So office may be a little tougher again. It's not like the sector is struggling by any means, but there are some issues in terms of fundamental performance, like tenants are demanding less space, more workers are working remotely. So that's leading to people wanting smaller leases or more flexible leases than they would in the past. So that's having some impacts on the office sector, which then might translate into future performance and your ability maybe to sell that asset.
Okay, so I know that during that story, we didn't really talk about retail, but what's going on in the power centers?
So with power centers, there's been a recent report which was somewhat surprising on the headline basis, which was that investment in power centers increased by 30% in the first quarter of 2019, making it the most active quarter for investment in power centers since 2016. That's according to research from JLL. Given that power center tenants like the big box stores have been struggling for years, has been one of the more hard hit areas for retail. So there hasn't been that much interest in power centers. It's been one of those parts of the retail universe that's struggled. So seeing that number, it did jump out that like suddenly, there's a big year over year jump. I think then they quickly did point out in the report that this, it's both like good news and bad news. It's one, yes, it's good that maybe that the power centers may have cratered and now there's more, opportunity and more interest, but it's also, it's partly such a big improvement because things were so low. So it's like, at some point things hit a bottom and they start coming back up, and so you're going to like have growth, but that doesn't then fundamentally mean that power centers are yet doing well. Yeah. I think the other sort of thing that was underscored here is that one of the reasons that investors are targeting power centers is because they've done poorly. So that means that there is more opportunity for upside. So these are kind of like opportunity plays, I guess. That's what we're seeing, an uptick in activity in the sector being driven by investors who, rather than buying assets that may have peaked or near peak, that maybe pretty high, have high occupancy levels, there's not as much upside when you buy that asset. Whereas if you look at a power center space, maybe if you have a business plan that can bring in new tenants or alternative tenants, then you can realize some returns on that investment. So I think that, for example, they pointed to healthcare clinics, potentially putting grocery stores in some of these kind of spots, doing that kind of thing, or fitness centers, other kinds of uses that may not have been there before. That may be the opportunity that people are seeing, and maybe part of why we're seeing higher transaction volume in that space.
Yeah, I mean, as good as it is to be able to shop online, you really can't, shop for a gym and get a gym membership online and use it well, or healthcare clinics. You're not going to shop for a doctor online and do it as well as what you could do as shopping from a big box store online. So it makes perfect sense that they're service-oriented investments or businesses that'll take those spaces, because you just can't do that any other way but actually physically be there.
Right. So it's about experiential retail, or about, right, you said services. That's kind of the future of some of these spaces that, in the past were the Best Buys, or more recently, even some of the bookstores that are still sort of like on the fence. There's just like so many of these concepts that are either, not expanding or closing or going out of business. It's a lot of real estate to deal with. But if you can fill it with something that's not just reliant on moving merchandise, but is about providing an experience, providing a service, like you said, that can't come online, maybe that's the investment angle here.
Yeah, absolutely. All right. I know our third story is about bank exposure, and it's actually their exposure their risk seems to be creeping a little bit higher, you said.
Yeah, so this is based on a piece of reporting, based on a piece of research from Credify. I think that they were cautious in how they put this out, which was that, they're not trying to say that there are high levels of risk in the system at this point, but that I think that they have found some concerns, just given that some banks maybe have too much exposure to commercial real estate at this point. And, I think the concern here is, if you look back to the last cycle, a lot of banks had a lot of exposure both to retail real estate and commercial real estate. Then, when the financial system came crashing down and the Great Recession hit, banks had a lot of bad loans on their books that was tied to real estate. So I think that's the context and the underlying concern. I wanted to read one quote from, we talked to the CEO, Eli Raisin, about this, and he said, "We did not issue this report to say all bank lending is problematic. It's absolutely not. However, certain areas of lending and certain institutions are taking on more risk, and we are simply calling this out." So I feel like that's an important thing to underscore when we talk about risk. This is not about raising the alarm bells that there are systematic issues, but that maybe some banks may be just getting a little bit ahead of themselves. Important piece of context is that overall there's about $4.1 trillion in total commercial real estate debt across all lending services. So we're not talking about a small amount of cash here. We're talking about banks that have a decent amount of exposure to commercial real estate. And I think of particular concern, what they did flag is that the risks that construction loans could pose at this point in the cycle. It's construction loans until the project is stabilized and the owner could refinance into some kind of permanent piece of financing. That's always the issue when things are, when everything is moving along smoothly and people are delivering their projects, getting them fully leased, able to stabilize the asset, then refinance or move on, that's fine. The problem could be if we suddenly hit some kind of bump in the road, and then therefore people get stuck. They don't actually deliver the property the way they thought. Suddenly there are issues maybe for both the borrower and the lender. The other concern that they tagged in here is that we're in a period where construction costs are rising. So, just given that the development timeline on a project can be a couple of years or more, you may have penciled out the loan at 75 to 80% loan to cost when you're, at the beginning of the cycle. Suddenly, 2 years, materials costs are going up, various things may be changing. Suddenly, now you're at 90% of, the loan to cost. That's, that can be a little dicier situation. What they also explained is that what that could trigger is that one of the results of the Great Recession and the problems that we had in the financial system were, some new rules for banks in terms of how much reserve capital they need to have on hand, or if they have what is called a high volatility commercial real estate loan, requires more capital reserves. So if some loans need to be reclassified as that suddenly puts some more pressure on, you have to have more cash on hand to cover reserves. That means you can do less, new lending. So it puts just kind of could put a drain on banks in their day-to-day business. One of the experts we talked to, Casey Conway, he said that he put it as, there is a possible day of reckoning coming when it comes to this kind of, issue, and it could be sometime in 2020 as some of these borrowers that were taking on the construction loans start trying to move to permanent financing, as we were just sort of talking about. So that's those are some of the key points that were in this report.
What do you think the banks are? I mean, I don't think the banks like taking more risk. I mean, what's the overall feel as far as the longevity of this situation?
I think it's hard to say. I think that's a really good question. I think that the exposure is not uniform across the board. So, some banks, this is not even, remotely going to be concerned about, that they have, they're properly balanced. They have a little bit of real estate. Even if some of it goes bad, they can deal with it. This might be more of an issue for, and which was true in the last cycles, that there could be smaller local and regional banks, which maybe, get a little bit overly ambitious in trying to finance a project. And then suddenly, that project or a couple of projects in their markets come to be an issue. That's kind of how we saw it play out in the last cycle. Is that obviously we had some problems with the big banks, but it was a lot of the small banks that also didn't really, weren't getting the big headlines, but had a lot of the workout issues and a lot of the stuff that, needed to be sorted out through the distressed process, or loans being taken off their books, or bank mergers, or all that kind of stuff. So I don't know. I mean, I don't think anybody's foreseeing a replay of the 2008 financial crisis, even with these concerns. Yeah. But it's just something that we should be aware of, given how deep we are into this cycle, and just given what's happened in past cycles.
Well, I'm hoping people are going to be a little bit more reserved, a little safer, maybe. I don't know. We'll see. We'll see how it plays out.
Yeah, and I think that was the thinking behind, the reserve levels that banks are being required to hold is partially meant to help offset the risk and help to prevent anybody from getting into the kind of trouble that they did last time. If you are required to hold some capital on hand, that maybe helps you get through any troubled loans you might have.
Yep, absolutely. And that's a great story about, learning a little bit from history and hopefully moving forward. Now, this next story is more about the future, right? I mean, we're talking about energy use requirements. And so apartment building owners try to grapple with these tougher energy use requirements. What do we need to learn from this?
So I think what we were looking at with this piece was how laws in various cities and states across the country that are attempting to regulate how much energy is being used and trying to be greener, how that's affecting particularly, specifically how that might be affecting apartment building owners. For example, New York City is requiring all large existing buildings of 25,000 square feet or more to make efficiency upgrades, or they face financial penalties. And that's on the extreme end, but there are other rules that are happening again at the city and state level. So, what that means for an apartment owner is, costs, at least in the short term, to make sure the building that you're putting up, or the building that you already have, can meet these tougher standards. So some of the industry trade groups that represent the multifamily industry, like the NMHC and the National Association of Home Builders, have tried to talk with legislators, or try to talk with other nonprofits about how to balance the goal of energy efficiency without it being too much of a burden on their members. So this is always, one of those, I feel like that's like a kind of a constant battle that takes place between, trying to get to a better end around, being more efficient or being greener versus like, okay, how is that going to affect our bottom line in the short term?
Yeah, I mean, it's great to be able to talk about that and strive for it, but a building that was constructed, 50, 60 years ago, it's not going to be easy to retrofit that with other things that are either going to help with insulation or whatever. It's not going to be nearly as good as any building that's built today with those types of standards. And I can't imagine somebody with that large of a building having to look and say, okay, how much is it going to cost? And is there a possible way to get this done without completely being bankrupt?
Yeah.
Boy, that's tough.
Yeah, and I think that's what you're like. That I think that kind of concern is in some of the other cities. What you're seeing is that a lot of these conditions are more focused on the newer. Like, okay, if you're building something new, you have to do X, Y, or Z. So it's just like it's baked into like the new construction as opposed to having to retrofit the older buildings. But like given the size of New York City and the number of buildings here and the amount of energy that gets used, there's just a lot of good that can be done if we can make them more energy efficient.
Yeah. Do you know what's on that list? I mean, just a few of the things that they're trying to have them upgrade?
So a lot of it does focus on the issue of energy usage and emissions. So I think there may be something about materials, but a lot of these specific laws that are discussed in the story are about like cutting emissions by up to 40%. So that's ultimately about the sources of I think the efficiency of the building itself. That you're not like that the structure isn't leaking cool or hot air, so you have to pay extra costs to kind of keep it climate controlled, or what your energy source might be.
Gotcha. All right, that makes sense. All right, and then our last story is about self-storage. Very interesting. What's going on with self-storage?
So self-storage is a sector that doesn't get talked about quite as much but it is part of the commercial real estate universe, partly because it's just like a very steady, typically it's a very steady business. It's obviously, not a hugely expensive asset type to operate. There's a pretty stable demand for it, especially, like self-storage facilities near campuses, like, those, there's not a whole lot of up and down. It's just like a nice steady business. But what the concern is suddenly is that maybe, there being too many built. So actually getting outpacing the demand that there might be in the market. So there's a forecast that stagnant rent. So rent, given that there are hundreds and hundreds of self-storage properties that are being delivered this year, last year, there's just been a lot coming on the market. Suddenly rents are stagnant because there's just a ton more competition. Now developers are finally tapping the brakes. So what they're projecting, we've both talked to CBRE and also data from Yardi Matrix, that looking out like not this year because a lot of the stuff's already in the works, but maybe next year there are going to be fewer projects delivered. So what that will hopefully mean is that this the pressure that's being placed on the sector and the declining rents, that will stop because there won't be as much of a intense amount of oversupply coming on the market. But the remedy is not like in the next 6 months, unfortunately. We're looking at more like 2020.
Got it. Yeah. I think just like you said, near campuses, it's all about location. If there's a location that is going to be high traffic that would be convenient for people to have a storage unit, like say on the way to a lake or a recreation area where people are going to say, okay, I'd love to be able to store my boat or RV or camper or whatever in this location because it's on the way back. I don't have to take it home. There's facilities to clean it off, be able to put it away, and then have some also garage type units for people to store other items. That's a great spot to have one, but it doesn't necessarily mean that they're going to continue to just kind of cookie cutter these suckers out and increase the amount in total, because I wouldn't think that the rent would fluctuate a whole lot for ones that are a little bit farther away from the other mass groupings of these types of buildings. What do you think?
Yeah, I think that's all exactly right. I think, it's pretty. If there's not too much going on in terms of like supply demand issues, that the rents are going to be pretty stable. Demand's going to be pretty stable. I think one of the other factors about self storage is that it's a sector that's kind of a tailing sector. It follows other things. So. Mm-hmm. If there's other kinds of development or other kinds of demand or other things that are happening that then create the need for self-storage, they come in. So there is some market by market differences. So I think there are some submarkets where the rent maybe is still rising 6 to 8% a year just because of the dynamics, but in mm-hmm. other ones, it has actually declined 2 to 3%. That's what one of the experts that we talked to pointed out. And I think one of the other points, or one of the other data points in the story that just spoke to its performance, was that if you look at the self-storage REITs, that their net operating income in the past year only grew between 1% and 4%, whereas when you look at the net occupancy income growth for other REITs, the self-storage REITs are trailing the mm-hmm. rest of the sector. So it's the rest of the sector. So it's just showing just another illustration of some of the pressures that have manifested on self-storage. I mean, I guess, the good news is that, income is not dropping, but they're just not growing as fast. And I think hopefully the thinking is as the development here slows, it'll help for the ultimate outlook for the sector in 2020 and 2021 and beyond.
Yeah. And if all else fails, David, we can, just like we talked about last week, you had a couple porta potties and you got yourself a hippie commune.
There you go.
A little hippie commune there. It's the whole tiny house movement. You could like a tiny garage movement.
There you go.
That's even legal. But yeah, who knows? They can convert some properties.
Sure, it's not unprecedented for someone to live in a self-storage facility, even if they're not supposed to.
It's not. I'm sure it's not. All right, David, this is great. Is there any closing thoughts for today's newscast?
Just want to thank the listeners for tuning in, for following us on our adventures into the podcast worlds, and remind people if they have feedback or thoughts, just to follow us and to drop us a line.
Absolutely. And I want to thank you all too. Thank you for listening to the NREI Weekender with your host, David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. Again, thanks for listening today. For everyone at the NREI Weekender, this is Eric Johnson inviting you back next week for all the news that matters to you. We'll see you soon.
Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of NREI Informa. The content has been made available for informational and educational purposes only.